reduction equal sign, pick this value the way it is. Why are we picking it the way it is? The statement is clear that this price reduced, it decreased to this. If you go to the shop today and they are selling a product at 1,000 and you go back tomorrow and they tell you that this price reduced, we've reduced our price to 800. There is nothing you're going to do like adding or what. You just pay your 800 and get the item that you want. So this is what we are going to do. So pick the 13,000, enter. And since they are not specific, and maybe again it's reduced to this, to this, to this, no. It seems it is going to be constant now for the rest of the years, because they are telling us that it reduced to 13,000 from year 4 to year 6. So just maintain your 13,000 here. The price is the same, and the price is the same, like that. Okay, so that is our selling price, and this is the output. What do we want to do? We want to determine the revenue. If you want to determine the revenue, ideally you're going to multiply the output by the selling price. So come and put revenue here. Equal sign, multiply. So it's going to be that times that one there. Enter and get your revenue in year 1, autofill to get the revenue in the different years. That's year 2 to year 6. Okay. Now,
Madam,
yes.
how have you got revenue?
How have I got the revenue? We are saying that revenue is got by multiplying your output by the selling price. So equal sign, your output times the selling price, enter, and then you auto fill. Like that.
Output, selling price.
Yes, output times selling price. I hope we are there. Okay. Now, there is something that we have in our investment detail, and that is a fuel saving. It is here. Fuel saving. And they are telling us that it is 3.9%. According to the question that we have, let me try to share this screen also. As possible. Anyway, let me just read for you, then we shall interpret. Fuel. It's not this one. Fuel. Okay. They are telling us here that the fuel saving, actually it's supposed to be fuel saving, not monthly. You correct that. The fuel saving is expected to be at 3.9 of the fuel cost. And the fuel saving is expected to be at 3.9% of the fuel cost. Now, if you have a saving, like the way we are having this fuel saving, it is going to increase on the revenue that we have. So here you're going to have your fuel saving. Going to have your fuel saving, and they are telling us that it is 3.9% of the fuel cost. Now, what is our fuel cost? Go back to your investment detail sheet. The fuel cost has been given, and it is 300,000. And it is monthly, and they're telling us that we have 12 months of course in the year here. So we shall just multiply the 12 months by the 300,000 per month, that's the cost, and then we shall get the annual fuel cost in a particular year. And out of that cost, we shall need a saving, or we have a saving of 3. We shall have a saving of 3.9. So what are we going to do? Not to disturb ourselves, we shall first leave that column. We shall go back to it when we get the fuel cost under the expenses. So after getting the fuel saving, here we shall need the total revenue that we shall also get. Just beg that you first keep those two. We shall go back to them after getting the fuel cost down. So after getting our total revenue, I've told you that we are working as accountants at first, and then we shall work as financial managers since we are doing cash flows. Okay, now let's go to expenses here as another small subheading. Remember, we are following the format of the income statement. This will be my total revenue. That will be my total revenue. Okay, let's capture the expenses. Go to my investment detail sheet. What are the expenses that I have? Let me start with my fuel cost. Okay, I can start with electricity. Now, electricity, they are telling us that it is 700,000 and it is quarterly. Quarterly, you're paying 700,000. How many quarters do we have in a year? We have 4 quarters. A quarter always has 3 months. So they've been kind enough to us and they've given us the number of quarters in a year, and that is 4. So how much are you paying annually as far as electricity is concerned? Ideally, we shall just multiply our 700 cost electricity by the number of quarters that we have in a particular year, and we shall get the final answer for electricity in a particular period. So go back to your initial cash flow and put electricity. In year 1, just put equal sign, go to your investment detail sheet, pick on your 700,000 and multiply it by the number of quarters that you have, that is 4. Enter and get your Oh, I put it in a wrong electricity cost. You're going to just get equal sign, go to your investment detail, pick on the cost that you have quarterly, that's 700, and multiply it by the number of quarters that you have. But before you multiply, you need to do cell fixing. So after equal sign selecting on your 700, fix it, and then multiply it by the number of quarters that you have, and then you fix it and enter. Enter, and then you autofill to get the rest of the values. Okay, let us continue. Next expense that we have fuel costs. And this fuel cost has been given on a monthly basis, and it's 300,000. But remember, when we are determining cash flows, we are dealing with years. Our period is always in years. So you just multiply still. And before we multiply, we have our fuel costs. Fuel costs. Equal sign. Go to your investment detail sheet. Pick on the monthly cost for fuel, which is 300,000. Fix it, F4. And then you're going to multiply it by the number of months that you have in the year. That is 12. You're going to fix it, and then you will enter and autofill. So enter and get your final answer. That is the fuel cost on an annual basis. So you have this autofill. If you don't fix, then it may not work for the rest of the periods. Now, still we need to be very critical once you're given a question. Sometimes they'll tell you that the fuel cost will reduce by this, it will increase to this, to reduce to this, increase to this, etc. So you have to read and try to understand the statement very well, and then you treat it the same way, just like the way we've been treating the output and the selling price. Okay, now since we now have our fuel costs, we can determine the fuel saving up here. Are we together? We can determine the fuel saving. They are telling us in the question that the fuel saving is 3.9% of the fuel cost. So go back to your initial cash flow sheet and just get off that saving. That it is 3.9% of the fuel cost. So equal sign. Go to your investment detail sheet, pick on that percentage. And since that percentage is going to be used all through that column, you're going to fix it, F4, times, go back to your initial cash flow and pick on the fuel cost annually.
Kino kyagezaako okutegeeza.
Nedda kitegeere. What I'm saying is, we want to get the fuel cost saving. And the question, they've told us that it is the saving that we have for fuel is 3.9% of the fuel cost, that you're going to be saving fuel of 3.9% on an annual basis, but of the cost that you have for fuel. Now, in our initial cash flow, we have the fuel cost of 3.6 annually. So how much will be the saving out of the 3.6 in year 1? The saving is going to be 3.9%. It is what they've given us. And that's what I'm trying to do. So equal sign, get your percentage for the saving 3.9. And since it is constant and you're going to use it all through that column up to the 6th year, you're going to fix it and you're going to multiply it by the cost for fuel in that particular year, which is 3.6. Enter.
Tuli kusoma kubanga. Maria, you record for me and you send me the methods. I've entered a bit late. Wait,
So enter.
Uganda one. Ebintu bingi.
And we just maintain silence. At least try as much as you can to pick something. When we meet physically, we shall have another example.
Madam,
Yes,
I have a question.
yes,
It's about the expenses.
yeah.
Electricity,
Mm,
getting the electricity cost.
mm.
Is it electricity times the quarterly?
Yes,
But-
the number of quarters that you have. Mm.
Then why didn't we use the fuel cost as well? Like fuel times the quarter. Why were we using again the month?
Okay, why are we using that one? In our question, why are we not using quarterly? The question is telling us that the monthly fuel saving is expected to be 3.9% etc. And then the fuel costs are expected to be 300,000 per month. They've not told us quarterly, but per month. Electricity is on a quarterly basis, but fuel costs are paid on a monthly basis. According
all
to
right.
the question. Is it okay?
Yeah. Yes.
So if they are telling you quarterly, then multiply by the number of quarters. If they are saying monthly, multiply by the number of months in a year. If they are telling you daily, then you multiply by the number of days in a year. Why a year? Simply because when we are determining our cash flows, we are doing them on an annual basis, on a yearly basis. Okay. So I'm going to go back to the fuel saving. They've told us that the fuel saving is 3.9 of the fuel cost that we have. So I just put the equal sign, go to my investment detail, pick on the percentage for the saving fuel. And since I'm going to use it throughout my row to determine that saving for all the years up to year 6, I'm going to fix it and multiply it by the actual cost that I have in a particular year for fuel cost. So the 3.6. Enter and get this value. Autofill like that. I hope we are together. Now, since we've got the fuel saving, I want us to finalize this part and get the total revenue. We have the revenue and then we have the saving. I've told you that this saving will always increase the revenue that you have in a particular year. For example, we can do it on a household level. And I hope we are together. Now, since we've catered for that, let's go back to our expenses and continue with our question. They're telling us that the distribution cost is 10 millions. It is annual. So just pick on your 10 millions. Go to your cash flow and put distribution cost equal sign. And pick on your 10 million straight away. And then you autofill. That one has been direct. Why am I not getting values this side? It is constant. Let me just fix it. So equal sign, investment detail, pick your 10 millions, fix it, enter. So this is constant all through plus 6 years. I've told you the hash values, these hashes always imply that your column is too small to accommodate the big value. Just need to increase on the size of the column to have all the figures visible. Okay. Now, let me go back to my sheet that has the details that I've captured. I'm here. Number of quarters, we've looked at it. We have labor costs. Now, labor costs, they are telling us that it is per unit and it is 2,000. Every unit that you produce, you pay labor of 2,000. So what is the total labor cost that you're going to have? Ideally, you're going to multiply the 2,000, which is the cost per unit, and multiply it by the number of units you've produced in a particular year. So I'm going to my initial cash flow, put my labor costs, equal sign, pick on your 2,000, which is a constant fee per unit, and I'm going to be using it for all the years up to year 6. So I'm going to fix it and multiply it by the number of units that I've produced in a particular year. Now in year 1, my output is that, the 1,000. So enter. So in year 1, this is going to be my labor costs. So 2 millions, me autofill to get the labor costs for all the other years. So it keeps on changing. It is not constant. I think you can see why we have varying outputs. Much as the unit, the cost per output is the same, we have different outputs per year. Therefore, even our labor cost is going to keep on changing. It is not constant.
I beg your pardon.
Okay. We are saying that we have labor costs given here. And this labor cost is per unit. That every unit that you produce, you're going to pay labor of 2,000. Now, how much is going to be your total labor cost in a particular year? It is going to be the cost per unit times the number of units that you've produced in a given year. Not so? Yes. So got your initial cash flow and you put your equal sign. Got your investment detail sheet. Pick on the 2,000, which is the cost per unit that you're producing. And since it is constant, whether you produce 10,000 over what, 20,000, etc., each unit you're going to be paying 2,000. So fix it, since it is going to be used all through, and multiply it by the number of units that you produce in that particular period you're in. We are in period 1, and therefore you produce 1,000 unit. To be the 1,000 and the 2,000 per unit. Enter and get your 2 millions, and then you autofill to get for the rest of the values. Okay, let us continue. They are telling us that we have raw material costs. Of course, now this is the amount they are selling the material at, the amount you're buying your material at, and they're telling us that per unit it is 1,000. So if per unit you're buying at 1,000, then how much are you going to spend to buy this raw material that you're using? Still get the cost per unit and multiply it by the number of units you're going to buy. That's what we are going to do. So initial cash flow, this is raw material cost. Raw material cost, equal sign, investment detail, pick on the cost per unit, material cost per unit, fix it because you're using it all through that row, and multiply it by the number of units. What's the number of units? Number of units is 1,000. Enter. Let me first cross check with this. Yes. Then. Okay. It's a mistake we've done. So to determine the raw material costs, ideally, it is going to be our selling price. Yes, the selling price that we are getting these products at, and then we shall just multiply it by the cost per unit. So it's simple, equal sign. Can first pick on my raw material costs per unit, and then multiply, fix it, sorry, and then you multiply it by, go to your initial cash flow, and multiply it by the selling price. Yes. Enter, and you get this. It is 1 million, 10 millions. And then autofill to get for the rest of the values. And it also keeps on changing. Madam. Yes. I pardon it.
No, why the selling price?
Why the selling price? Let me first go back to my question. Let me go back to my question. I look at it critically. Let me look for the question. This is material.
Madam, you promised.
Material cost. First wait. I shared the document with your course leader, the question. The material costs are expected to be 1,000 units out. Okay. The question is telling us the material costs are expected to be 1,000 shillings per unit output produced. So we go back, it is per unit. Get my 1000, fix it, and multiply it by the number of units that I'm producing. Now, the question always guides us on what we are supposed to multiply with. So of the output, enter, and then we auto fill. So there you are. So that will be the material cost. So go back to your investment detail. What else do we need? We need the depreciation. Now they are telling us that depreciation is on straight line, and they've given us the amount of 62,000. I told you that we are first working as accountants, and for them, they know that depreciation is a cost. It is an expense to the business. So if it is an expense, we shall first add it to the expenses that we have, and then we shall later be in position to remove it to get the intermediate cash flows. Now, in case they've not given you the depreciation, and the question has given you the period, has given you the cost, and it has given you the salvage value, then that means that still you need the depreciation amount. Therefore, you're going to come up with the depreciation schedule that we looked at and get the depreciation amount for all periods. It is that amount that you're going to take to your cash flow. That's if they've not given you. But if they've given you, you just pick on that depreciation amount that they've given you, and things will be simple for you. Okay. So I'm going to my initial cash flow. Put my depreciation, I'll abbreviate, equal sign. Got my investment detail. That is my depreciation amount that I have. So click on it. Since it is going to be constant, after clicking on it, you need to fix it. Fix it, enter, and then you auto fill. So we don't have any other expense. So I'm just going to get my total expenses here. Equal sign, and I sum up all those expenses. Close your brackets, enter, and you auto fill. You auto fill. Okay. Now, we have the total revenue and we have the total expenses. So if you have total revenue and total expense, ideally you're going to get your earnings before interest, before tax. Yes, those things that you know. So I have earnings before interest and before tax. How do I get that? You're going to get the difference now. Get this, then you subtract the expenses that you have. Oh, someone is making noise for us. Okay, so this is what we have in year one as our total earnings before interest and tax. Autofill. There you are. So we have expenses as compared to the revenues. That's why we are having this. It is negative. Last time I told you that sometimes they'll bring the answer in brackets and sometimes they'll bring it with that minus sign. There is no need to worry. They are all correct. Okay. Now, I've determined we need to get now the tax component and then the interest if it is needed. Now, how do you know that you need the interest for this case? You will know that you need the interest if the money that you're getting to purchase that particular fixed asset is in form of a loan. The question is telling you that they use the loan to get the money to buy the asset, then that means that there is no way you will escape that area of interest. And they're not going to give you that interest. You just need to come up with an interest or loan amortization schedule that we looked at, and you determine the interest for that case. You have the loan amount, you have the life interest to be given. They'll tell you that they are getting a loan of maybe 20 million at an interest of 15%. So if that's the case, then ideally come up with the loan amortization schedule and determine the interest that you're going to put here. Is it okay?
Pardon?
We are saying that in case they tell you that they are using a loan to purchase a particular asset, then that means that they'll give you the loan amount they are getting. You have the period. Therefore, with those three variables, you've been positioned to come up with a loan amortization schedule that you're going to base to determine the interest that you're going to put in these years. That's year 1, year 2, year 3. They have told you for depreciation, then up with the depreciation schedule to determine the depreciation amounts that you're going to put there. So this loan, this amount, they didn't specify. Therefore, we are assuming that they didn't use a loan. But if they tell you that they used the loan, then that means that you need a loan amortization schedule to determine the interest that you put here. So here we'll say less interest, and you put that amount. Where are you going to get it from? You're going to get it from a loan amortization schedule that we looked at. If they're kind enough and they give you the interest amount for each period, then we just pick on that amount you've been given and then you put it in these different years. I hope that one is clear. Once it is a loan, I'm saying that in case they are using a loan to acquire an asset, then you need to determine the interest. How are you going to determine the interest? You're going to come up with the loan amortization schedule to determine that interest that you put in the different years 1 to 6. But if they are using retained earnings, they have their own money, they didn't go to the bank, they didn't borrow the money, then you don't need this interest. For what? Because it is your money. Okay, so for this case, we don't need interest. Why? We are showing that we used our money. The company used its own money, maybe the retained earnings it had. Okay, so since that's the case, I'm even going to remove the I and I'll just have earnings before tax. Why? I'm not going to compute interest. We use the company money to buy this asset. Okay, so we shall less tax. this tax. We have the tax. They're telling us that taxation on profit is at a rate of 35% according to the question that I shared with you. We didn't summarize that in our investment details. Let me just put it here. The tax is 35%. Sorry, 35%. So go to your initial cash flow and get off the 35% equal sign. We have that in our sheet here. Fix it, multiply it by the earnings before tax, that one. Enter. So that will be the tax component. You did the things in accounting. It should not be new. Okay. So if you have a tax, then ideally you have earnings after tax equal sign. To get earnings after tax, you're going to get your earnings before tax and you less the tax amount that you have. Enter. So this is what you have as your earnings after tax. Autofill. So I want you to compute up to there, earnings after tax, then we shall continue. I've given you 2 minutes.
Madam, you left me on earnings before tax. Beg your pardon.
I hope we finished. Okay. So we have our earnings after tax. And this is where the accountant is going to stop. So if it is an accountant, then you will conclude and say that I'm making losses. Why? Because of these negative values, losses. But a financial manager is going to add back depreciation because according to him, depreciation is not an expense. You don't see money actually moving out. Remember, financial management looks at money in, money out. If the asset is depreciating, then that means that money is not moving out in actual sense. So to get the intermediate cash flows, here, we are going to add back the depreciation. Maybe I first put add back. Let me just put add depreciation like that. So what is the depreciation amount? It is here. Equal sign, pick it. I'm going to fix it. Okay, let me see if I don't fix it, whether it will come. Pick it. It is constant. So it comes there like that. So to get your intermediate cash flow now, so intermediate cash flow, it is going to be equal sign, the earnings after tax, which is this one, and add up your depreciation amount. Enter. So this is what you're having there as your intermediate cash flows.
Excuse me, madam.
Yes, yes.
Get intermediate cash flows. How do you get intermediate cash flows?
Okay, getting intermediate cash flows, we are saying that you're going to get your earnings after tax and add your depreciation. Enter, and then you auto fill. So you get your intermediate cash flows there. Get your intermediate cash flow. Now, how do you determine the terminal cash flows? Now, the terminal cash flows, these are cash flows at the end of the useful life of the period. And we say that you must be having the salvage value added back to the cash flow that you have in your final year, which is year 6. And according to our investment detail, we don't have salvage value. And if we don't have it, we assume that the salvage value of this asset in year 6 is equal to 0. So if it is equal to 0, then my terminal cash flow, let me first put salvage value, much as it's not given. Salvage value. Since it is not given, we are assuming that in year 6, the salvage value of this asset is 0. But if it is given, then you have to put that value that they've given you. Now, salvage value is either given as net salvage value or just salvage. Now, if they give you as net salvage value of maybe 2,000, I'll just explain this. If the salvage value is 2,000 in the question that you have, then that means that you need to get the net salvage value. Whenever you're selling a product and a fixed asset, there is always a tax component. So you're going to get the tax percentage to, you're going to subject this salvage value to tax, and then you get the final salvage value that you're going to put in year 6. How do you do that? You just put equal sign, get the salvage value into brackets, or multiply it by the tax component, but the formula is 1 minus the tax. Now the tax is 35%. So you say 1 minus the tax of 35% from your table here. You close your bracket. Oh, it has failed. Capital increased maybe by 2,000. And in the final year, this working capital was recouped. You got back your working capital that had increased. So in case you have working capital increase and it was recovered in the final year, you're going to add that working capital that you've recovered here. And you come and put the amount there. Maybe if it is 2,000, you put 200, etc. Just put the amount there. And then you get the total of whatever that you have here to get your final terminal cash flow. You have to note the issue of salvage value. If it is not given, 0. If it is given as salvage value, you have to get the net salvage value. How? Get the salvage into brackets 1 minus tax. And if you have working capital increment recovered, then you also have to add it to the value that you have this side in your final year, because always working capital is recovered in the last year. Since we don't have all those things, I'm removing them. Okay, I don't have working capital, therefore I ignore it. Now there is a question on our MOBSEP that has all those details. I'll just request you access it and practice it. In case of any challenge, you always ask a friend, you can always contact me and I'll always explain. Okay. So that is salvage value added back to our intermediate cash flow. So the final terminal cash flow now, terminal cash flow, it is going to be the sum of what I have here. Enter, and then I auto fill. I'll auto fill like this up to there. So I think you can see that even in the last year, the cash flow that I have for intermediate is the same as the one I have for terminal. Reason being, the salvage value is 0. But if we had salvage value of maybe that amount, enter, then I'll have an effect on my final answer. So this is 0. So there is no problem with that. So in my last year, or in my last project, my terminal cash flows, or the cash flows that I'll be having, are these ones here, and they are negatives. But you still also need to know how much you spent at the beginning of this project. So put the equal sign, go back to your first year, just pick that, put it there. In year 0, to be consistent, just pick the value that you have as your initial cash flow and put it here, such that you have complete cash flows. So that is that. Any question? Any question? Any question?
I have the same values under expenses, but I'm getting a different total.
And to explain why, if you're following, you've been using the same methods.
I have the same values, I've been using the same methods, but then have different totals. I don't know how. Maybe you made a mistake.
You.
Maybe I, maybe you, I don't know.
You're not sure.
Hello,
I
madam.
think we didn't make any mistake. Yes. Total expense.
how we got the less tax?
The tax, tax, we've said that we have the percentage of 35%. We had not put it last time. That was in the question. The 35%. I just put equal sign. Then picked on my tax percentage, the 35. I fixed it because it is going to be used all through, and I multiply it by the earnings before tax, and I entered. Okay, let's look at the last concept. And that is now appraising this investment. Remember the process, we say that you identify as many alternatives as possible, you screen them, just screening them, you're going to evaluate them using the cash flows. That's what we've been doing. We did the initial, the intermediate, and then the terminal. And then the last step is to appraise and take a decision whether to invest in it or not. So here I'm going to put appraisal. I want to appraise my investment. I want to appraise it using the different techniques. I'll use two. Then I'll request you to look at others. We have that tool to be used to appraise. We shall need the value, and then we shall need the decision, whether to accept or not. This is what I have. Now we shall look at the NPV, the net present value, and then maybe we shall look at the IRR, the internal rate of return. I don't have it here. Okay. So NPV, net present value, want to see the actual worth of this asset. The values should be in how much do we have now other than the future. So to do that, there is a syntax for NPV in Excel. Just put equal sign NPV. This one is simple. Now telling us that it will return for us the net present value of an investment. It's going to be based on a particular rate that we shall be having. Let me look at my question first. Oh, they're telling us the rate is 20%. It is here. It is 20%. So let me capture that. I can just put it here. Means that the required rate of return, that is RRR, required rate of return. Put it in black. The required rate of return is 20%. The question has captured it. Okay, so to get NPV value, equal sign NPV, open your brackets. They're telling us that you need the rate variable, and then you need the variables, the values you're considering. So the rate that's required is there, 20%, comma, and what are the values? Now, the values are the cash flows that you've obtained, and we are going to make use of the terminal cash flows. So, comma, and just select the values for your terminal cash flows like this. Close your bracket, enter. Then what is the IRR, the internal rate of return? Just put equal sign IRR, open brackets, values, they are here. This one, sorry, I pardon on the last one. This
No,
what
why
we
is
are on. Sorry?
not the dollar sign?
Why the dollar sign? It's not formatted. We can just format it to any, to the one that we want. So close. You know, these techniques were not developed for Ugandans. That's why sometimes to always reflect the dollar sign, but you can format it to UGX. So enter. Oh, it's not working. Let me repeat, equal sign.
Excuse me.
IRR. Yes.
We're not seeing the values in yellow.
In yellow. Okay. Let me change the color.
Yes, blue, not yellow.
Equal sign. IRR. Open brackets. These are my values. Yes. That is bringing hash. Let me try to check on this. Don't see any mistake on my formula. Just repeat it one more time. Equal sign, IRR, open brackets, the values are here. Close my bracket, enter. I just cross check with it, but I don't see any value. Never know yours is working because the
But
formula
madam,
is really right.
madam,
Yes.
Madam,
Yes.
but it said IRR open brackets, the values, then
the values,
guess.
then guess.
But
Guess
I think you're
factor is
looking at it.
always, no, the guess factor is always ignored. At least I explained that even in the beginning. Because I have another example here. Let me first see. My values. No, I'm just assuming that most probably because we have only negatives, maybe that's why it's not working. I'm thinking because the formula is actually right.
Try making them
Madam.
positive.
Sorry?
Madam,
Try making them positive.
We make them positive, no?
No, for illustration purposes. And you
Okay.
see if it will work.
Okay. Let me try to have these values here.
Madam, what if we put the values and then we just guess? Like yes, then close.
No. Let me first do this. Let me try it out on these positive values here. There's a problem. I can't trace it.
I think we are supposed to guess.
I don't think. Guessing what the rate?
Madam, let's
try. Let's try guessing. These values here. Comma. Guess the rate. No, it can't be. It is the right formula. We just need to look at further and see why it's not really working. But
Madam,
that is the right formula. Yes?
I think because we are dealing with negatives, maybe that's why it's showing that.
Yeah, that's why I even tried it out here. It was not working. Let me show you an example that I have here on my screen. Let me share you this screen and I show you what I'm trying to mean. New share. Investment. Okay. There is this example. Are you seeing it?
Yes.
Are you seeing this screen? Now we
Yes.
have these values here. These are the cash flows that we have. Year 0, it's a negative, and all the other ones were positive. The rate is 23%. And if you try to determine IRR, equal sign IRR, open brackets, pick on these values, close your bracket, it gives you the percentage here. Something I'm trying to now think about why it's not working. Let me first go back to my original share. Take this as a positive. Let me try to take it as a positive. Let me first type it here. 8662700. Let me delete this. And I put this here. Okay. And I put it there. I determine my RRR. My RR, two brackets. So I don't think we like this kind of one. Okay. So that works. So maybe the problem is this question wasn't so exact. I was just picking one values for demonstration purposes. Maybe that's why it was failing to work, but that is the right formula. You're going to get that example on MobSep. Actually, it's an exercise, and then you try it out. In case you fail, you're going to contact me. I don't think whether there is any problem with
On NPV.
Sorry?
NPV.
Pardon, on NPV. Okay, NPV, we are saying that put equal sign NPV, open brackets, and then pick on the rate, which is 20%, comma, and then the values that you have. Wait. And then the values that you have. Close your bracket, enter, you get your value there.
Okay.
Now, let's look at the decision. So, comma, open brackets, you're going to accept that investment or that decision. Else, meaning if it is less than 1, you're going to reject it. Close quotes, close your brackets, and enter. So they are telling us that this investment is not good. Why? The NPV value that we've got is less than 1. We are saying that it is in negatives. So don't take on that investment. Remember, we are looking at making decisions on whether to start a particular project or not. And the values that we have will always guide us. So reject it. Why? NPV is less than 0. If NPV is greater or equal to NPV is great. If NPV is greater or equal to 1, accept it. But if it is less than 1, you're going to, then in most cases, you need to get more information about that decision. Get more information about that investment. Don't just accept it because it may not even be worth undertaking, or you must have got even an error as you were computing. So note, if NPV is greater or equal to 1, accept. If NPV is less than 1, reject. And if you get exactly 1, get more information before you accept that decision. Okay. Now, IRR. I'm assuming that I have IRR. Let me use this other share. This one. That's for it is clear. If I get my IRR, for example, here, this IRR of 37. So if my IRR, open brackets, if this IRR is greater or equal to the required rate of return, what is the required rate of return? It is 23, comma, you're going to accept it. Else, meaning that if it is less than the required rate of return, you're going to reject that investment. So, comma, you reject if it is less than the required rate that you have. Close your bracket, enter. So here they are telling us accept why this IRR that we have is greater than the 23 that we have. Therefore, the investment is worth undertaking. Are we there?
Yes.
Okay. So that's what we are supposed to look at as far as cash flows are concerned. Now, they can tell you to determine the accounting rate of return, ARRR. The formula for that, you'll get your earnings. You're going to get your average annual profit, and then you get your annual net book values. So in case, but it is rare, they ask you for ARRR, then you're going to go back to your cash flows, assuming these are my cash flows. Where? Here. You're going to go to your cash flows and get the average of that. Add up all of them, divide by the number of years, and then all over, divide by your average net book value. That means that you have a depreciation schedule. Get NBV and get their average and still get your answer. So ideally, you need to go back to financial management, do further reading about cash flows and
pardon, madam, on that.
I pardon on ARR. ARR, I'm saying
yes,
that you get the average of your earnings after tax, divide by the average net book value of that asset. So if they are talking about net book value, then that means that you have a depreciation schedule and you get your NBVs from there. And we looked at that last time. Okay, so that's all. I'm going to request you kindly do the exercise that's on MOBSEP. It is equipped. It is technical, but at least I've explained all the concepts. They are saying output increased it to, reduced it to, increased it by, interpret them properly, and then just do simple arithmetics, additions, subtractions, multiplications, and you'll get the answer. If they've given you values in dollars and there is an exchange rate, please convert to UGX, to be consistent. If you're getting money from the bank, you need a loan amortization schedule to determine the interest that you're going to put in your cash flows. You need depreciation, that one is a must. If they don't give it to you, then you need to determine it yourself. How? We looked at a depreciation schedule. Okay, so you're going to repeat that question that we've been doing. And then number 2, do the exercise or the question that's on MOOCSEP. And we shall be getting as more examples as possible. When we meet physically, you ask where you don't understand. And still, you may not wait to meet in class. You can always contact me and I will always guide you where necessary. Otherwise, I think you're going to have another person take you through data table, solver, scenario manager, etc. And then you get another person to take you through the project part. Just need to wish you good luck. Have a good morning.
Madam, help us with your number.
My number is 070